Uh, Hello, ladies and gentlemen. These are some of the key features of income statement. Remember, income statement must have a title, and within the title, it bears the name of the business and the period under which you are ending your accounting or financial period. So within the income statement, the first item is the total revenue. So in most cases, you will be having total revenue of your business. Maybe if you are a retail business, you can talk of the sales that you have made during that particular trading period. Maybe the trading period, your trading period ran from 1st January 2020 to 31st December 2022. So that is your accounting period. So during that period, the total sales that you have made, or maybe the sales revenue that you have earned, they will be amounting to your total revenue. And therefore, the total amount of goods or services that you have sold during that period, the revenue that you have received will be under your total revenue. Then from the revenue, we subtract the cost of goods sold. So cost of goods sold in a normal in a business that produces goods and services. Maybe we can take into consideration the cost of raw materials. We can take into the consideration cost of labor, and therefore all those costs that you incur in production, such as the raw material, the material input, or the labor that you hire for production purposes. They will be amounting to the cost of goods sold, and therefore we subtract the cost of goods sold from the total revenue. So I put the cost of goods sold in bracket to denote that we are subtracting it. From the revenue. Then what we get after subtraction is what we refer to as gross profit. So gross profit is calculated by subtracting cost of goods sold from the total revenue generated by a business. Then gross profit becomes the first earning of your business, and therefore from the gross profit as part of the income, we add other income that the business might have generated during the trading period. Maybe the business maybe your business has other undertakings. Maybe it has invested in real estate somewhere, and therefore rent income that it earns from those real estate, it has to be added to the gross profit so that we get the total income of the business during that period. Then we subtract all expenses from the sum of the gross profits and other income. We subtract expenses that the business incurred during the trading period. Maybe administrative expenses, maybe traveling expenses, maybe payment of utility bills such as electricity bills, payment of water and sewerage bills, payment of insurance premiums, rent expense. If you are operating in a rented premises, you have to pay some rent, and therefore all those expenses, they are added together. We have the general expense or sundry expenses, these small expenses that you incur during the trading period. It has to be subtracted from the sum of the gross profit and other income. And therefore, what you will get after subtracting expenses, remember expenses are also put in bracket to denote that we are subtracting. When we put it in bracket, then less expenses. Then what we have is the pre-tax income. Pre-tax income, we can also refer to it as earning before interest and tax. Earning before interest and tax. So in that case, if there is any interest payment, we are going to subtract it from the pre-tax income, and then after subtracting interest payment, then we have the tax. And in most cases, we are talking about corporation tax. So corporation tax is subtracted so as to give us the net income. Remember, now this net income is what will partly be retained by the business and also partly distributed to the shareholders of the business. Thank you, ladies and gentlemen, for watching this.